Hi everyone, my name is Elisabeth Desmarais, and today I will be presenting Alpine Income Property Trust, ticker PINE. This is a real estate investment trust with a current price of $18.14 and a price target of $22.55. Alpine Income Property Trust is a real estate investment trust REIT that owns single tenants net lease commercial properties. The company focuses on high-quality and diversified industry-leading tenants in target markets and currently holds 24% of its portfolio in Florida. The company owns 51 properties located in 36 markets, 18 states, across 18 industries in the United States. The company has strong real estate fundamental, focusing on risk-adjusted leasing term and credit-worthy tenants. The company issued its first IPO in November 2019 and is headquartered in Daytona Beach, Florida. Alpine Income Property Trust is a relatively new REIT that began publicly trading in November 2019. It is important to note that to qualify to be a REIT and avoid corporate taxes, a company must give at least 90% of its profit to shareholders as dividend. Alpine has new acquisition of $17.4 million net leased to major clients such as Walmart, Walgreens, Kohl's, and 7-Eleven. The company also has a weighted average remaining lease of 9.3 years for those three new acquisitions. The company also has strategic geographic, where 21% of its annual base rent is located in Florida, and has focused on having tenants that are resistant to e-commerce, such as Walgreens, Walmart, and 7-Eleven, which kept their operation open during the pandemic. The annual growth rate of Pine is above peer average, thus 31.6% over 18.6% of peer group. Currently, Pine's occupancy rate is 100%, which is very outstanding currently in commercial REITs. Lastly, Pine has strong dividend yield of 5.2%, and that is why it is recommended to add Pine to the AIM Small Cap Fund with a target price of $22.55, representing an upside of 24.55. The first driver is acquisition and occupancy rate. Since its IPO, Pine has been focusing on acquisition and growing its portfolio in diversified and attractive location. The rent growth strategies focus on creditworthy tenants while keeping occupancy rate high, which are currently 100%. And in their last quarter of 2020, the company has collected all of its rent and is expected to continue their performance based on alleviated COVID-19 restrictions. While deferred payments have been allowed due to the pandemic, Pine has negotiated lease extension when asked for deferral rent requests. They have implemented stricter penalty for missed payments and have secured steady income streams into the future, while reducing the risk associated with lease termination, such as capex maintenance and tenants replacement that would eventually result in high cash outflow and less rental income. The second driver is retail and office recovery. As we know, the numbers of COVID-19 cases have been decreasing, and we have seen the positive effects of the vaccine, which automatically impacts the retail and office industry and Pine's rent collection. Recently, the House approved President Biden's $1.9 trillion stimulus plan. The recovery plan of the U.S. economy and the increase of massive federal government stimulus package should increase consumer spending. In January, consumer spending from stimulus checks rose by 5.3%, which resulted in higher profits for retail during that first month of the year. This results in less deferral and more consistency in the future for Pine's business and lead to a potential midterm rental income growth of over 8%. The third driver is taxes policies from Biden's administration. New proposed tax policy could have significant potential benefit on REITs. The potential increase of corporate taxes from 21% to 28% would give a competitive advantage to REITs over S&P 500 companies who are currently paying corporate taxes and would potentially see their taxes increase in the upcoming years. Another policy that could impact REIT include the removal of the 1031 exchange, which currently allows deferral of capital gain tax when swapping one investment property for another of the same value. Since REITs can complete an op-REIT exchange, which incite people to sell to REITs in order to defer gain tax, the elimination of the 1030 exchange would be a benefit. Ending the 1031 exchange could increase the buying process, since sellers who do not wish to pay taxes would be left with the option of selling to REITs in order to defer their tax from their gains and benefiting Pine's business process. For the valuation of Pine, an asset value model was created using a cap rate of 6%, which resulted in an intrinsic value of $20.48 per share. A price to FFO multiple was also calculated in using a peer average price to FFO multiple of 17.05 and a 2021 estimated FFO per share of $1.47. An intrinsic value of $25.04 was attained. Also, a discounted dividend model was also constructed using a cost of equity of 7.26%, which resulted in an intrinsic value of $21.33. Finally, a DCF model was constructed using a terminal growth rate of 2% and a WACC of 4.92%, which attained a $25.77 value. By weighting the models 40, 30, 20, and 10%, a price target of 22.55 was reached, resulting in an upside of 24.30%. Pine currently pays dividend of 5.20%. Pine's risks include tenants concentration, COVID-19, and entertainment tenants. Pine's largest tenants include Wells Fargo and Hilton Grand Vacation, which accounts for 19% and 12% of the total consolidated 2020 revenue. Accordingly, Pine's portfolio depends on these two major tenants, and if their business gets disrupted or underperform due to different individual risk factor, Pine's revenue could significantly decrease, and the company's risk to be materially impacted with an increase. The second risk is COVID-19, where another wave of the virus or a prolonged economic slowdown would have an adverse effect on operation of specific retail and office tenants. This would limit the growth of large tenants such as Hilton Grand Vacation, where their operation benefit from open and running economy, permitting travels. Stronger regulation would also positively impact e-commerce and negatively impact Pine's tenants' operation and business model. The third risk includes entertainment tenants. The entertainment industry has seen streaming platform dominating the market majors increase in subscription, impacting theater and physical entertainment options. Those properties take up 8% of Pine's portfolio and implies potential risk considering the difficulty to replace tenants for theater, especially right now with all the streaming platform on the market. Pine is currently externally managed by Alpine Income Property Manager, a subsidiary owned by the parent company, Consolidated Tomoka Land Co., ticker CTO. The president and CEO of Pine is John P. Albright since the launch of the IPO in 2019. He has served as president and CEO of the parent company since 2011 and has a lot of experience in the real estate sector, investment banking, and commercial development. As Senior Vice President, CFO, and Treasurer of Pine since 2020, we have Mark E. Patton. Mr. Patton has past experience with REIT, the hotel and lodging industry, where he worked in the sector with other individual companies. To conclude, it is recommended that Pine be added to the AIM Small Cap Fund with a current price of $18.14 and a target price of $22.55, representing an upside of 24.30%. The company has high-quality, diversified, industry-leading tenants, continuous portfolio expansion, strategic geographic and targeted market, as well as strong real estate fundamentals, risk-adjusted leasing term, as well as credit-worthy tenants. Thank you for listening to my presentation.